Welcome to our special session, a question and answer with Jim Dalton. It's Saturday, April 22nd at high noon, or a little 1 minute after. This is being recorded, and we welcome all of your questions. And we also welcome you to the webinar, and thank you for being here. Appreciate it. And we'll get to as many questions as we can. And I guess I'll leave it at that. I can't think of anything else. So, Jim, I'll turn it over to you.
Okay. I have a couple things I want to talk about that I think are really important before we go into the question and answer period. I have been in a process of putting together a webinar / a whole new statement position on risk, and it combines risk monitoring for continuation and market confidence. As I go through this and rethink this whole thing, most people, when you're talking about risk, they're thinking in terms of, where do you put your stop? How do you know when to get in and when to get out? Etc. It is the question of risk is much, much larger than that. And we had some great examples this week, and particularly on Wednesday. I know that one of our longtime clients got hurt fairly badly on Wednesday, and I can see exactly how it happened. Let me just go and just start talking a bit about some of the days that we saw take place this week. I'm going to start with okay. I'm going to start with the 13th. As we see on the 13th, the market rallies in the morning, makes a new high, and then it leaves a poor high. So you record that that's a poor high. Then for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 period. We went a little bit above on this area, which would be the JK period. But for all practical purposes, we sold off for the remainder of the day. The sell-off on this day, if I recall, correspond very heavily to crude oil. I think I'm right. Crude oil was breaking fairly sharply. So the point that I want to make here is risk. So much of risk is not in terms of numbers. It's not in terms of knowing where to get in and where to get out. It's in terms of understanding really what took place in a market and understanding, particularly if you're doing short-term trading, inventory conditions. As we went home on the 13th, the market was dramatically short. I'm now going to split out the following day. And what you see on the following day, the market opens up, and it starts to trade higher. Now it's a very strange day because we one time frame all day long. Never did we stop one time framing. You have to take out the prior bar by 2 ticks to stop one time framing. When I look at a formation like this, it appears to me to be a very weak formation. And weak because the buying is so mechanical, taking place at, these two E and F period took place just a single tick, or exactly at where D period low, G and H are close together, I's close, J, K, L all close together. And when I look at this, normally what you think is that you have momentum, weak momentum buyers. And that's how I saw the market initially. But there's something else going on. When you look at the trading on this day, what you have is a market that is tremendously short. When the market goes into a short covering mode, what happens in the fat part of this is, and this is where we say it's important to understand the emotions of two participants in the market, yourself first and those you are competing against secondly. What is going on here is that the shorts from the previous trading session haven't had enough time to all cover. When shorts haven't covered, they're holding on and they're just hoping that they can get out and, and salvage something on their position. When that doesn't happen, as we get closer to the close, they throw in the towel and all the shorts finally have to cover. The pressure just is too much. And just think inside your mind, think of yourself when you've been caught short and the market won't, some people are buying every time they get a little pullback, but think about the pressure that it puts on you. So what I think is going on here is a delayed reaction to the short inventory. And finally, they have to throw in the towel late in the day. We take out this poor high, we leave another poor high. So now, when we're talking about risk and understanding, the market gets too short on Friday. Then we have short covering all day on Monday. But what else goes on? When short covering takes place, prices start to trade higher. When prices start to trade higher, that brings in the momentum buying. So you get a combination of the short covering, which triggers the momentum buying. So we go from a market that's too short on the close on Friday to too long on the close on Monday. So we got the short covering, price goes up. Price is the energy of the momentum traders. This is their systems, tell them to buy because price is going higher. So we go from too short to too long. But notice the pause in the middle. Now I'm going to collapse these days. I'm going to come over and expand Tuesday. So now we come in on Tuesday and we've got a market that's gone from too short to too long. So what happens on Tuesday, is the market gets caught. They don't get any relief. The short or the longs, don't get above the previous day's high. That starts a liquidation mode. As we said, the inventory that was too long, that inventory, then here's that pause. This is the real point I'm trying to make. You have this pause where the longs are holding on, praying to anyone that will listen to them, let me out of this trade and I won't do this again. So here we had the pause, the market went up. Here we have the pause again. Finally, the towel is thrown in. The longs liquidate and we go back down. And that finally cleans up that longs. And so, but I want you to feel what happened. So there wasn't new selling here. This was liquidation. It's that idea that not understanding the inventory conditions of the market done by particularly the weaker hands traders really is where the risk control comes in. So now let's go back and let's see as the week goes on, see if we see this phenomenon again. Come in on the 19th, and we have a market on the 19th that one time frame lower all day long. Never does it stop one time frame. Again, I think this was, if I remember right, this was also related, maybe the first one wasn't, but this one was clearly related to oil. You had at one point better than the $2 drop. It was back down around the $50 level. When you have a market that one time frames lower all day long, you never stop one time frame. Remember, to stop one time framing, you would have to take out the high of the previous period by at least 2 ticks. One tick, and it never got. So they never got a chance. The shorts kept selling. So the market is very short. And you even see, here's a sign of momentum traders again. One tick above a previous high, they sell it. Right at the previous high, they sell it. One tick above the previous high, they sell it again. Just feel this inventory getting shorter and shorter and shorter all day long. Now we come into Thursday. I'm going to collapse this day. And expand Thursday. And here's the day that I know hurt a couple of people pretty seriously. Understand coming in that the previous day, the market one time frame lower for the entire day. What do you think is the inventory condition when the market closes on that day? And remember, so much about short-term trading has to do with inventory. A lot of people don't understand that. They're looking at all under indications. They're looking at fundamentals. They're listening to news and reports on economics, etc. And sometimes they'll impact the market. But so much, if you're going to be a short-term trader, has to do with the inventory condition. So we go home on Wednesday night, the market is again 100% short. Never did it stop one time frame. We opened the following morning above, if I take this as a lower distribution, so we open the following morning higher than kind of this lower distribution down here. So what does that tell you as the market opens? It tells you that all of the late sellers on this day that took place in the last 3 or 4 periods, they're underwater. Anybody that sold is underwater as we come into the following day. So you've watched price go down all day on Wednesday. Believe me, that has an impact on you. You see it all day long, and it's really hard to get your mind straight that this market isn't really weak. Now, there's some clues it's not. If it was that weak, it would have taken out the previous day's low. One of the things you remember, one of the things we say is what didn't happen is often more important than what did happen. So that in itself is another element when you're trying to understand risk in the market. So risk in the market isn't necessarily, because you've identified a place to put a stop or, know where to get in or where to get out. It's this lack of really understanding what is going on underneath the surface and with inventory and with the people you're competing against. If after selling all day, one time framing lower, I'm going to break it out one more time. Just think this through. If the market is one time framing lower all day long, and if you had any real selling. I think it was mostly liquidation. People got too long on the previous day, and now they're liquidating. And now once they're liquidating, then the short-term momentum traders are selling again because all the momentum signals are saying sell. If you had any serious or stronger sellers, I mean, those people that really, are meaningful about selling, not just trading, you're not going to one time frame lower all day long and not be able to get out the low of the previous day or not get the outside day. The fact that that didn't happen is a very valuable piece of information from two aspects. Knowing that if you're short, you have a tremendous risk, but also knowing that the chances of having a good long opportunity are pretty high because these people are caught short. And what comes in, we come into Thursday. So for the first 4 periods on Thursday, market trades higher. It opens inside the previous day's range. So the first thing that comes to my mind is, okay, we have a rotational trading day. But if you then say, wait a minute, a lot of short inventory from the previous day. Now the market moves sideways for 4 periods, 2 hours. So 2 hours, if you look back over, this is the point of control. The point of control on Wednesday did not migrate lower. It stayed higher. So when you see that, it also is another sign that this was weak selling, liquidation, weak selling, very emotional. Now we opened, it's been 2 hours, and we're back up to the point of control. We're back up almost to the top third of the previous day's range. Maybe we are. And think about this. How many of these traders are in trouble? You can take a pretty good guess that there's an awful lot of shorts from this previous day. The market was up when we opened in the morning. These people are underwater that kept their positions. Once we get back up to the point of control, anybody that sold for most of the day in short and took on short, they're underwater. They have not had a real chance to get out of the market. So what happens, again, we have this delay. And just mentally feel these people that are short. Feel yourself if you've been short sometime, and you're just praying that you're going to get a chance to get out and correct this position. And it doesn't happen. The longer it doesn't happen, the more you're likely to throw in the towel. And then this is what happens. The towel gets thrown in. The shorts are forced to cover. One more time, as price moves higher, the shorts cover. And then that also brings the momentum buyers back in. So we get whipsawed again. We go from too short, shorts are covering. We go up, very thin market going up. And look at all the different distributions. Shorts are covered. The new buyers are coming in, following price. And now we go home. We were too short at the end of Thursday or at the end of Wednesday. By the time we go home on Thursday, we're just the opposite. We're too long. The market's just, we're in a trading environment. The market's just whipping traders around. So now you come in. Notice the delay. Remember, each day we had a delay. Now we come in and the market is too long on Friday. Let's spread Friday out. Then on Friday, the market opens about unchanged, and it sells off really slow. I mean, it just was agonizing down here, agonizing. Again, there's this delay, and look what finally happens. We said from the day before, I think the market was too long, went from too short to too long, and then what do we get? We get this liquidation break, cleans up the inventory, and the market comes up and settles about in the middle. So this idea of understanding inventory, and it is particularly important because we have been in a trading environment for about 2 months. And what's a trading environment? That just tells you that there is very little participation by the longer, more serious buyers and sellers. They're just complacent to sit on the sidelines. So without their interference in the market, it's the short-term traders that have taken over the market. And the market is just, it's just trade back and forth. Inventory too long, inventory too short, inventory too long. And that's what I think happened. Now we come in and we're balanced. And finally, as we went home on Friday, my guess is inventory was pretty balanced for the week. Now, what I've just covered is absolutely, it's very revolutionary for most traders, because most traders would like to feel the markets are more understandable from the point of view of, being able to look at references or being able to look at structure and, be able to control, what they do in that manner. One of the things I've said over and over again is that when the markets are too long and you get a liquidating break, or too short, you get a short covering break. At that point in time, that is the current business that has to be taken care of. And structure falls by the wayside. Now, you may pick up clues from the new structure that's developing and what may happen going forward. But previous structure is overridden because the market has to take care of current business first. Now, what I've covered is extremely important. It's, for most people, going to be very revolutionary because it's not how you've been accustomed to thinking. You're more accustomed to thinking in terms of looking at levels and where do I buy, where do I get out, rather than this bigger understanding of what really is the inventory condition of particularly a trading environment. Julia, this is a question and answer period. I will now shut up and I will attempt to answer questions.
Well, thank you. I have a few comments on what you just talked about. Number one, everyone bear with me. With regard to Monday's trade, the overnight action on Sunday was also about 95% net short, which exacerbated the short position or short inventory conditions from the 13th.
Okay. And that happens. So a lot of times people have a tendency, the overnight market is generally controlled by weaker hands traders. It's not 100%. There's something major going on. Anybody may be there, but for most purposes, it's weaker hands traders. There's a great tendency to follow, what the last thing they saw before the New York markets closed. Overnight inventory, it's an indication that the traders are, it's weaker. The volume be about 25% on average of what it is, versus the daytime frame trading. So, but it's not uncommon for them to exacerbate the situation. Okay, thank you.
Yes, and it's really a great situation when you're coming in the morning. You can get better trade location and all that. So, do you use, give me 1 second. And let me comment to everyone, we're doing a highlight reel that will be released tomorrow. And the reel is for Tuesday, April 18th. However, in the supporting document, Jim talks about Monday, the 17th, and he also talks about the Wednesday, the 19th. So you'll have more analysis and, more commentary on this if you're feeling a little, few gray areas. But you'll get that via email tomorrow. After F period, after the liquidation, we were at the previous day reference.
I'm sorry, what day are we talking about?
Well, this is early in the webinar, so I would imagine, where is the F period low? Let me get to my window trader. I can't really, I'm recording the highlight reel. Let me go back.
Now, whoever sent the question, just tell us what day.
Tell me what day there, Carlos. The 18th. Thanks. Thanks for that.
Okay, go ahead.
Oh, okay, yes. Okay, I'll ask it again. After the F period liquidation, we were at the previous day reference. And I suppose that's the open. I'm not quite sure, but we were at that previous day reference. Do you use that reference as a potential reversal since the inventory for all morning has been to the downside, having in mind that if we take a long there, our risk is minimal to the low from a period of the previous day, which is the low of the day?
No, the reference from the previous day, you may be right. The reference from the previous day being the opening was not part of my consideration at all.
You're saying the low, Jim. The low
For
of,
the
you
reference,
marked
but
the
the
low of a
low,
period.
I'm assuming he's talking about the open.
No, he said the low, our
No,
risk is minimal to the low from a period of the previous day.
yeah, I don't know. That wasn't part of my consideration whatsoever. That doesn't mean it's not. And you're right. In hindsight, you can say yes, the risk was minimal if you put your stop down there. But in my thinking, when the market's broken this hard, you don't know that. And if you win, it's a lucky guess. Maybe it wasn't. Maybe you just had a good feeling for it. Because we did have a poor low up here. So I can understand that. But it's an acceptable.
A poor high.
No, there's nothing. It was a poor high from the previous day. And that would give us two back-to-back poor highs, which tells you the odds are not very good. We get a lot of continuation. But if you did that trade, and that's fine, as long as you have a reason for doing the trade, and as long as you know how to monitor for continuation. What you'll see on the highlight reel is that there was a buy in there. I let that buy play out, and the buy came, in my opinion, came in the G period. But you'll see it on the highlight reel. What the highlight reel is going to show is that F period came up within 2 ticks of the A period low, and the traders sold the market off again. G period comes up 1 tick above the A period low. The market sold off again. And the highlight reel is going to show that this was my clue. So the market, they sold it off once, they bounced it, they sold it. This was my clue that what I had were mechanical price sellers selling as close to closing this distribution as they could get, because we had a double distribution when E period broke down through A period. So F period comes up and falls 2 ticks short of closing the double distribution. G closes it, and then the traders sell it off again. Very mechanical type of selling. And when I saw this, I said, okay, it was already short. They sold it off. They got it short. They sold it off again. They got it short. And as they sold it off near the low of G period, that's what I saw as a buy, because you have an excess low, and it just felt to me that the market was getting too short. So again, it's my analysis. My trade wasn't dissimilar from yours, but my thinking was different. I gave it more time to play out and more time to see what I thought was going to happen to the inventory conditions. Okay, another question.
Okay, how could you tell in real time that there was no new selling in E and F period on the 18th? It seems like only something you could know at the end of the day.
That's a good question. One is by having an understanding of what I just talked about. And what I talked about is understanding that the inventory on the 17th went from too short to too long. Then when I see the E period break, you have to make an assumption that it's more than likely inventory liquidation. But I don't know if that's right. I don't know if there's more to it. But as I watch what happens in F period, G, and then H, then it's pretty clear to me that it's not new selling. It's just liquidation. And also remember, I've got two back-to-back poor lows. I have a poor low from the 17th, a poor high from the 17th, and a poor high from the 18th. So these, when you're talking about becoming a successful trader, you are never going to find exactness. And you're never going to find assurance, and you're never going to know till after the fact. All you can do is make business assessments. Is what do you think is happening? Years ago, when I was working for Merrill Lynch in Santa Ana, California, not too far from Santa Ana, over in Corona, California, was a RV manufacturer called Fleetwood Mobile Homes. Merrill Lynch had a very poor relationship with Fleetwood. So their chances of ever getting any corporate business from Fleetwood were very limited. Well, I was the newest guy on the Merrill Lynch trading floor, and Merrill Lynch had to deliver some proxy information to Fleetwood. So everybody knew there was no chance of getting any business from that. So why waste their time? So they give it to the new kid on the block. So I have to drive from Santa Ana, California to Riverside or Corona and deliver this proxy material to Fleetwood. Total waste of time is what everybody thought. Well, in the process of doing this, I was able to get in to see Jack Dahl, who was the senior executive vice president of Fleetwood Mobile Homes at the time. And as we walked in, Jack, made some comment. He laughed. He said, he knew exactly what's going on. He said, "You must be the new kid on the block." And I laughed and I said, "Yes, I am. How'd you know that?" He said, "Because we're not going to do any business with Merrill Lynch, so anybody that comes over here certainly isn't a knowledgeable person." And he wasn't being nasty. He was just being, very honest. And we laughed. Well, anyhow, Jack and I talked for about an hour. And one of the things that was very interesting, he was sharing with me how intelligent business decisions are made. And he said, when you make a serious business decision, you're making that decision with about 60% of known information. He said, if you know any more than about 60%, it's not a very good business opportunity in most cases. That conversation struck home with me. And I've remembered it all these years. And you can see I apply that same thing when we're talking about making a decision. When you say, how do you know that there wasn't new business in there? And the answer is you don't. But I am accumulating other information. I have two poor highs, which understand that the majority of traders out there, they have no idea what we'd be talking about if we're talking, well, that was a poor high. They look at you like you're crazy because that's just not something. Most people are so focused on price, and they'll say, oh, they'll see that as a bearish sign because that's a double top. And and I look at it, I see, to me, it's an indication that there was no real aggressive selling up there. So it's part of the information. Then I look and I say, okay, if this market was really that weak, probably would have one time frame picked up volume, stayed elongated for most of the day, which it didn't do. But I still don't know that for sure, right? But as I watch, and this is why I suggested to Julia that we do the highlight reel on Tuesday. And because this to me was a very interesting situation. You've seen price go against you. You've seen some pretty rapid liquidation coming out of this E&F period. But then I watch the selling and I say, all I've got is liquidation. I don't have new business. If I had new business, it's not going to come up to 2 ticks above the A period low. G period is not going to take it by 1 to sell. The new business selling, seriously, they're not going to wait for that exactness. So when I look at that, I said that this is more short-term traders, late laggard short-term traders, and they're getting caught short in the hole. But if that's how you put the information together, but you're absolutely right. You're not going to know that there wasn't new selling in the E period, but you have to make some intelligent business decisions. That's where opportunities come from. You have 60% of the information. Okay, another question.
Yes. It's also, I don't know if you mentioned it, but the point of control was 5 wide as it spent a couple of hours, in rotational trade there. So that was another structural clue that
Correct.
perhaps, that was overdone, along with the poor highs and inventory conditions being adjusted.
And keep in mind what we just said, this was also, to understand the traders got caught long, this was also that, that delay, they hanging on, and once you break through this, they give it up, throw it in, and, and that's all it was. They traders, they finally wore them down, they threw it in, and that was the end of it. Okay.
Okay. And someone's saying, so you need to take out a reference point, for example, a poor high by 2 ticks to confirm a change occurring or, continuation.
Yeah, again, don't make it a science. Think in terms of whether they're matching highs, 1 tick, 2 ticks. What I'd like to do is think in terms of aggressiveness. Was there an indication of real new aggressiveness up there? When you make a high like this, and you don't only have any excess, you don't have a series of single prints. The single prints would tell you that there was some aggressive selling in there. When it happens that there's no single ticks or just a few, even if there's 2 or 3, it's not a sign that there was aggressive selling. More than likely, the market just died of its own weight, and traders went from a buying mood to a liquidation mode, rather than reaching someplace and all of a sudden new money came in and said, wow, this is the opportunity I'm looking for, and begin to sell. But I just want to caution you against making it a science. You're absolutely correct. It takes 2 ticks to make an excess high. And when you're learning something, you have to have some kind of a rule. 1 tick isn't, no ticks isn't, 2 ticks is. But again, think in a much broader term of what happens, and think about, was there aggressive selling in there? So if there's not aggressive selling and the market goes down, it even starts to gain momentum as it goes down, more than likely what you're seeing is liquidation rather than a combination of liquidation and new money selling. That thinking, being able to think in terms of that, is so important to understanding risk and understanding opportunities when they present themselves. The clearer the opportunity is, the less it's worth in most cases. The ability to be able to think, understand the inventory, understand the structure, and say, okay, accumulating the evidence is just so powerful.
How about those late sellers on Wednesday are just liquidating and not opening new positions?
Okay, now we're talking the 19th. Now we've moved to the 19th, correct? That's the 19th.
Daniel, would you just confirm that? Are those late sellers on Wednesday, aren't they just liquidating and they're not opening new positions? Yes, the 19th, Wednesday. Thanks, Daniel.
Wednesday. No, I suspect that what you're seeing in here is, think in terms of the diffusion model. You have the innovators, early adopters, early majority, and laggards. When you get to this spot in the day, you probably have a combination of laggard liquidators, those that hung on and hung on and hung on. So that's one. And liquidators of old business. Now you probably have another set of laggards, and that is the momentum traders that have watched this market one time frame lower all day, and they finally decide that they have enough evidence to become sellers. So my guess is that on the lows like that, you have a combination of laggard liquidators and laggard new short sellers opening positions, because they now have enough evidence watching price all day long that it's time to sell. And that's really where you get where the big traps are set. Now, if you were looking at this in a vacuum, and let's say you didn't have any prior day to measure it against, it's not as clear. But when I look over here and I say, okay, with all that selling, they can't get out the low from the previous day, that tells me that more than likely I'm not seeing new sellers. If I was seeing a combination of new innovative sellers and liquidation, I'm probably not going to have any trouble getting out that low at all. And also, if you start to think, so what do you got here? You got one low, one low. You see how close these lows are together? That's a sign to probably some mechanical buying down there, trying to buy a trend line. And you'll see where I address that in, that becomes an important consideration when I'm looking at the markets and the strength. You'll see that in the weekend report that will be coming out tomorrow. Okay, but good question, but I think your assumption is wrong. I think it was a combination of laggard liquidators and laggard new momentum shorts.
Okay. And as Jim mentions the report, we have 2 remaining Kickstart reports coming out tomorrow and on Tuesday night for Wednesday trade. So if you're in the Kickstart program but not enrolled in the Mastery Series, you will receive those reports. However, if you are enrolled in the Mastery Series, those reports will be identical, but you'll be receiving the Monday trade recap and preparation report Sunday, and then on Monday morning we begin in earnest with the reporting part of the Mastery Series, where you'll get a morning report. So if you're in the Mastery Series, be checking your inbox, because there are 2 daily reports coming at you from this day forward. You know, Monday we start that part, and you can open the training site and go to the chat page, because Jim will be making chat comments. It may be a little more limited because we're not in full swing, but he will be on the chat. I just want to mention that while we were on it. Can Jim? Oh,
let me continue. What we have tried to do, there's a lot of people that are new to us, a lot of people that are new to the way we trade, the way we look at markets. So we've gone out of our way to try and build a base of understanding prior to the start of the May 1st Mastery Series. So we had the Kickstart program. I think there's 7 or 8 webinars in there. Some of those are heavier than I intended them to be. Then we're starting the full reporting this week, and also we'll start light chatting this week. Again, all in preparation to give those that are newest to us the fairest chance possible to understand what's taking place as May 1st comes around and we start the first of the 2 Mastery Series. Thanks.
Okay, thanks. Can Jim show how/why he concludes the market is in a trading range for the past few months? Show on the profiles. Thanks.
Just look. You know, I mean, you just look at it, it's back and forth, back and forth, back and forth. It's just so much comes from observation. If you switch over, and you'll see on the, I guess I don't have that I don't have that open. Hold on just a second. You know, when we start and you look at the monthly, weekly, daily bars, it'll be much clearer. For example, this month is an inside month relative to last year. That clearly says, trading. We have many overlapping weeks. It says trading. You'll see in here many overlapping days. So it's by observation. It's by observation that you say it's a trading environment. There's nothing else going on. Okay. Another question.
The difficulty comes when overnight inventory is added to short-term inventory and is contrary to the short-term inventory. Who's going to cover first? It's not easy. And this is commented on in the highlight reel supporting document as well.
Okay.
Different mix of traders and that sort of thing, but go ahead, Jim.
Okay. Here's one of the things that we say about overnight inventory. Okay, hold on. This is up. Before I get to that question, let's just go back. Okay, there's the daily bar, moving sideways. 1, 2, 3, 4, 5. I mean, look at all this time. Again, when somebody asks me that question, my guesstimate is they probably have a cognitive bias that thinks the market's either in an uptrend or a downtrend, and that's sometimes that blinds us. But if you take a second and you look and you see how many days we've moved forward, so we broke out of this on this day is what the February 13th, I believe that day is. So February 13th, here we are at April 22nd. We've gone nowhere. That's a trading range. So again, it's nothing other than observations to lead me to that conclusion. I'm sorry. Okay, now let's go back to the question about overnight inventory. And somebody said it's confusing, and that's a great.
Yeah, and he's very versed in this.
Yeah, it's a great question. So let me just kind of review what we say about overnight inventory. 65% of the time, and this is just, it's just observation for a couple of the previous intensities that Julia kept score. About 65% of the time, you see a counter auction relative to overnight inventory. Now, that counter auction can take several forms. So if the overnight inventory is short, a full counter auction would be the market rallies and takes out the high of all the overnight trading. That would be a full counter auction. Another thing can take place is the market really wants to go lower, but it rallies, the market holds for a while and even rallies a little bit in the morning because the overnight inventory is covering. They're covering, so it restricts the advance of it restricts the decline that may be coming. Or the third situation is the market disregards overnight inventory entirely. So overnight inventory is 100% short, and the market immediately go down anyhow. That's another great piece of information. It tells you that the market was in fact even weaker than you might have thought because the overnight inventory was short. The market doesn't care. It's going down anyhow. So that confusing part of overnight inventory, if you learn how to think about it correctly, can be helpful in understanding what's really going on in the market. So inventory that's tremendously long or short and the market doesn't react to it tells you that's a good piece of information, i.e. 100% short, market doesn't care, it's going down anyhow. That's probably a pretty good sign that it's a weak market. When you think about anytime we have a gap, if you have a gap, you're going to have inventory that's, if the gap is going higher, you're going to have high inventory, overnight inventory. And, if that gap doesn't get filled, that's a sign the market is really strong. Go with it. So there's many ways to use the overnight inventory. The most difficult thing about overnight inventory occurs when, let's say, for example, overnight inventory is long. You get an immediate liquidation when the market opens, counter auction to overnight inventory. And once that counter auction is over, then the market starts higher. That's the one that traps you more than anything, because you've seen price going down. If you didn't understand price was going down as a counter auction to overnight inventory, you think the market's weak, you get short, and all of a sudden the market tears back up to the other side. Or the market's 100%, short, you get a short covering rally, and, once that short covering rally countered overnight inventory, once that's over, the market sets down again. These are difficult markets. So you have to have a much fuller understanding of what is really taking place in order to be successful. Remember, the amount of people that are successful doing short-term trades, very limited. Also remember that we just had a thing, I think Warren Buffett put that bet out there, and over a 15-year period, the indexes beat most of the large money managers that people pay a lot of money for. So there's not a lot of other people that really understand the markets. You have to understand, particularly a short-term trader. Short-term trading can be very rewarding, but you have to think about it in terms far beyond numbers. You have to really be able to understand what's going on under the surface, what's going on with the inventory, because so much of short-term trading, is adjustments to overnight inventory. Anyhow, but it's a great question, and I understand the confusion. That's faced me many times, but I've tried to lay out a way to think about it. Okay, thank you.
Okay, two similar questions. I'll read them, and we'll see. We have been experiencing a long trading range with traders going from too short to too long. Could you show from the previous months an example of a healthy trending structure? What does it look like? And perhaps I should leave it at that, Jim, but I want to put this gentleman's question in. Can Jim show strong money examples in real trading?
People are always asking that question. Show me what it looks like. And there isn't that neat answer isn't there. But if you look right down here, we're looking over at the bar chart. Looking at the bar chart going back, and you see an excess. You see a clear excess. Well, when you see a clear excess like that, more than likely, that's serious money. Now you see another clear move. You see that followed by a gap. More than likely, that's pretty good money coming into the market. The reason, and now I'm going to go to the monthly bar. When you look here, when you look at the monthly bar, that's a pretty good sign right there. You don't have to go and have specific profiles to show you where it is. There's other factors. That's why I always start, and you'll see when you get the report this weekend, you'll see I try to give you some idea of how to lay out your daily research report. You always start, at least I always start with the monthly bar. I start with the monthly bar because I want to know if I'm getting supported by longer term money coming into the market. And when I see a monthly bar, moving along like this, I have a pretty good idea that I'm getting continual monthly support from longer term money. It doesn't mean that they're in there, every single day, but I mean, on a net average, they're adding to the market. Then you'll get to a point where they, just like short-term inventory, when we get too long on short-term inventory, we often correct it in the next day or two. When you get too long on longer-term inventory, it may take some months. So it's one of the things we've said before, when you see a break like this, then the market continues back higher. Very often, this break is an indication of what is to come. It is an indication that it was just a little too early for the market to fully correct, or to fully offset some of the buying, but it's a forerunner of what's to come. And we've talked about this for years, so this isn't something new, but then you fall asleep, right? Then the market comes up here and it actually moves sideways for 1, 2, 3, 4, 5, 6, 7, 8, 9 months. It goes a little higher, but it moves sideways. Then you get another break. Then the market goes up, then it comes down again. So you'll see in here, so the long-term money was fully, they were constantly adding to positions. That doesn't mean they weren't selling some things, buying other things, but on a net basis, they were adding to the market. Yet in here, you go for 1, 2, 3, 4, 5, 6, 7, 8, whatever, how long a period, so a very long period of time. At this point in time, the commitment has slowed down. They're far more cautious. They're not overly selling, but they're taking some profits, rearranging portfolios. And so we go from, a trend to trading range, and then we go back to trend. But notice as we go back to this trend, down in this area, you got these back and fill areas, but it constantly went higher. Even when we broke out of this, we came back into it. That's a sign that it's very, very late in the game. Now, then it makes another run up in here. So now where we are is we've been one time framing again for 1, 2, 3. Remember, this was following the election. Following the election, everybody got excited about the market. And this started, for those of you that are new to what we're saying, these are other important concepts. You don't very often, at least anymore, hear us use the term initiating and responsive buying. Initiating buying is buying that takes place where people are willing to pay 12 for something they could have bought for 10 yesterday, 14 tomorrow for something they could have bought at 12 today, 16 tomorrow for something they could have bought at 14 today. That's initiating buying. Okay, when that takes place, looking at the longer term side, that's an indication that longer term money is coming into this market. The night of the election, the futures market was limit down. It traded at limit down for over 2 hours. The fact that it traded for 2 hours at limit down was the most valuable piece of information I've received in some period of time. When a market is limit down, normally what happens, it stops trading. The limit says it can't go below that, but it traded at that limit for 2 hours. And so what was happening down there? Panicked people that had heard all the stuff that, if Trump won the election, that was bad, the market would go down 5%. Boy, they're not going to miss that opportunity. The longer term money is down there saying, I buy, I buy, I buy, I buy. Reported that Carl Icahn was the guy down there buying everything he could get his hands on. Well, that market then started up, and now let's go back. What was the election date? What was the date of the election?
U.S. presidential?
Yeah, November, right?
What is it, the third week in November?
Let's see here.
Let me see. Help me out here, guys. November 8th. Oh, the first Tuesday in November. Pardon me. My civics lesson for today. Thank you, everyone. November 8th, Tuesday.
Okay.
Yeah, he's on the monthly chart.
Yeah, what was see? This is December I'm looking at here. No, oh, that's a November 1st. That's the chart. Okay, so here's the election. I'm sorry, I kept seeing D. That was the day.
It's
So
a monthly chart, though. Yeah.
There's the monthly chart. Okay, and that with the election, remember, it really started on the night of the election when the market was limit down and there were buyers there. Well, then what happened? You get this huge move to the upside. And then the market, so this is longer term money coming into the market. Whether they're right or wrong is another question. Now, let me go back. I don't think my profiles go back that far. No, I don't. My profiles don't go back that far. But you'll see elongated profiles in the market. You'll check the volume, and you'll see the volume was healthy as the market was rallying. So those are the signs you're looking for. You're looking for value every day. You're looking at the monthly, then you go to the weekly, and you'll get a pretty good idea if longer term money is coming in, flowing into the market or not. So it's not, you don't get it based off a perfect profile. You get it more looking at the monthly, weekly, and daily charts. This is why I always start there. Okay, and when I look now, or I'm right now, I say, okay, for 2 months, we're basically, I think this is only a couple handles above, so I think it's 6 handles above the low from last month. So here we are, the 22nd of this month, we've gone nowhere, and I make the statement, we've moved sideways for the last 2 months. So let's go take a look at the weekly. There's the weekly. We've moved sideways. So again, that's how I come in. Okay, another question.
I'm with you. Are the results of the French elections going to change the opening level on Monday?
I don't know. I mean, who knows? I mean, look what happened. If you look at all the conventional wisdom about our election, everybody said, oh, if Trump won, the market was going to get killed. What did it do? Just the opposite. How much did they know? How knowledgeable were they? Not very knowledgeable, right? So you don't know those things. You always have the pundits talking, thinking they know, but they don't. They don't know. You have to take and look at the market. Let the market tell you what the real opinion is. Okay, other questions?
Jim, on the 18th, would you call the lows a spike? I went long overnight, but sold too early in the pit session. How do you keep your wits, or do you have any suggestions of staying in a position? Back to the 18th. Maybe make that a little larger too, please.
I'm saying, you went long where?
I went long overnight, but sold too early in the pit session because the overnight was short on this day. It went back to the point of control
Okay.
and then some from the 17th.
Well, no, I don't know how to answer
He
that.
said he meant the 19th, not the 18th. I'm just seeing
okay.
his later comment.
Oh,
Sorry
okay.
about that.
Okay.
My apology.
Okay, the 19th. Okay, this is also, as I'm saying that I am working through a whole new presentation on market confidence, risk, monitoring for continuation. And I don't know when I'll be ready with this, but there's a lot of revolutionary thoughts going through my head. And one of the things when I'm talking about risk management has to has to do with exiting trades too early. And when you take a look, so if you understood why you got long overnight on the, I guess it's the 19th, if you understood why you got long overnight, you had, you're talking about, let's see, got long, but we're talking about long on the 19th, right? Yeah. So if you're looking at that, you say, okay, why did I get long? Because you thought the market was too short. Then, and one of the most prescient comments that I've ever heard came out of Julian's mouth one time. We were on a webinar. It was a short covering rally. She had been trading actively, and it just flowed out of her mouth perfectly. She said, when you look at the market, do you think this market's gone up enough to let all these shorts cover? And I had never used that statement before. I've stolen it and used it many times since. Not just the statement, but the thinking. You learn so much from teaching and listening to people. But that was such an insightful comment that I said, I've incorporated that into my thinking, and it's helped marvelously. So if you're talking about, you get out too early, part of the thinking is one to understand that the inventory is too short, but also understanding the people that you are trading against. They are still, more than likely, they are still going to be selling into rallies. And that can mislead you tremendously. And on Thursday, I'm going to split this out. On Thursday, the market's up here. It was grinding very, very slowly. The temptation to get out was huge. The temptation to go short was huge. In fact, confession time here, I actually did buy some puts.
Truth comes out.
The market went down. It got below the opening. It wasn't even the opening. It pulled back a little bit. It pulled back. It was in C period. Here it is. It's right there. It was in C period. I had bought them up in here. I had good location on them. Then when it came back down to the opening in C period, if you were watching the market, there just wasn't anything there. It just didn't exist. And at that time, I looked at it, and it was very hard for me because what it amounted to after the bid and the offer, and I'm now revealing one of my weaknesses, what I was going to make on that trade was about 30 cents a contract. And I'm like, well, that's not even worth it. When a thought like that goes through your head, you're dead meat. Because at that point in time, you're no longer objecting. You're now thinking about your loss and how you're going to feel and everything, or your small profit, was it worth being in? And that has hurt me so badly in the past. And now, remembering that, I come out of the trade. And of course, it was reading that there was absolutely nothing there. But then it came back to my head, I probably shouldn't have been in that position in the first place because the shorts had not had a chance to cover. So that's what saved me. That observation, reflecting back on that inventory hadn't gone enough to cover, because this went up to the point of control. So all this early stuff was still underwater. So, and those are the kind of considerations that you have to go through. It's not easy. And I understand how that trips us up sometimes. But part of this whole new risk reward, risk in the market, confidence, continuation has to do with that kind of thinking. Being able to stay with a winning trade, give it more room to work. So I don't have a full answer to your question. I do know that on that particular day, in C period, when the market traded back down below the opening price, and remember, for daytime frame traders, the opening price, early morning low, half back are all important indicators of what the market's really doing. But that drawing up of volume and just no momentum when it got below the opening was the clue that says, you're wrong, the market's going higher, not lower. Questions?
But of course, let's see. You said you waited to allow the buy to set up. Now we're back to the 18th in G and H. You said you wanted to allow the buy to set up. Was that G or H period? Would you consider any TPO in the H period a bad trade location? Parens without the rest of the day on the screen.
I'm
sorry. Would you consider
I,
any TPO in the H period bad trade location? You know, just in terms of,
I just don't understand the question.
If you entered long at the high TPO in H, at what point would you consider yourself wrong if it went against you?
If it got more than 3 or 4 ticks back down into the
below A period.
Yeah. What you want to do is, when this happens, I wanted this to be filled. G period was very helpful because it stopped the one time framing. Came back down and volume was light. Remember, the light, the red is, or the white is light volume. And then, you know, you look 1 tick below G, then now you have 1 time frame for 2 periods when you get into H period. So getting back into this distribution, into this lower distribution, into the upper distribution, there's nothing wrong with that as trade location. So again, it's hard for me. See, I never think in terms of exact places where I'm getting in or where I'm getting out of a trade. No more than probably 5% of the time, if I'm trading futures, does a stop take me out of a trade. I enter when all of a sudden it dawns on me that the situation is correct, and I exit when it no longer feels correct. It is not based on price. It is not based on stops. To me, a stop is a fail-safe of all, something radically goes wrong, some terrorist movement or something goes wrong that's going to kill the market. I want someplace to take me out that I don't have to think about. But in most cases, there's nothing exact about the places I get in and the places I get out. Like, people are always saying, well, we want to know where Jim gets in and gets out, and how did he pick that price? And it's just like when I'm talking about my exit on, where was it again? My exit, let me close this stuff up. It gets, on the C period exit here, it had nothing to do with a price, nothing whatsoever. It was just, I'm sorry, it was just saying that there was nothing there. If you went back and played that day, the market went down below that opening, got down 3 or 4 ticks. It was just nothing. And at that point in time, it's not a price, it's just get out. And then get out, then you reevaluate if you want to get back into another position. But again, there was no exactness. There's no exactness to it. Okay?
Okay. Andrew, if I'm not understanding you with this answer, please come back. That I just typed in. If the majority of overnight inventory is long, but it's trending down, which way do we play that? You know, it might have stayed long all in Asia, but then 3 a.m. Frankfurt, you know, I'm talking Eastern time, you know, it continues to trend for the day, but looking at the overall profile, it may present as long inventory. But truly, for the
So
last, you know, 6
so
hours,
what
it
I'm
might
hearing
be
is
lower.
the market's trending down, but overnight inventory is up, 100% up.
Well, maybe not 100%, but it's long. He's using the example, but it's trending lower. You know, maybe it stayed long in Asia and then Frankfurt opened and it started to go lower.
Overnight inventory is trading.
Yes.
Overnight inventory is long, but overnight inventory is trading lower as we near the opening of the U.S. markets.
Yes.
Okay. Well, there's no exact way to play that. You say overnight inventory is long. The expectation would be for follow through. If you don't get downside follow through, and you're going to say, okay, when the market opens, so we start to trade off, what's the chances that we're going to get unchanged value for today? And with overnight inventory, as long as it's been trending down, if there's really anything there, you would expect some pretty fast liquidation as the market opens. If overnight inventory is long, trending down near the opening, but you don't get follow through, watch out. The market's more than likely going to turn back to the upside. Again, there's no set rules. Everything is a series of facts surrounded by other circumstances. For example, let's say that the previous day was up, the previous day was strong. There was not a very prominent point of control or anything that said that should retrace the day. And now price follows through overnight and inventory is long, but they got a little too long and it's coming back down as we get near the opening. At that point in time, going back to the previous day was strong. If the previous day was strong, good structure, good volume, then you're going to have to get well back into the previous day's range. You're going to have to see that value is going to be at least unchanged. But if you open and you don't get that follow through the downside, chances of value being at least unchanged, now the market's probably going back higher. There's no absolute. There's no absolute to these things. Everything has to be considered within context. So you take another example where the previous day had a just, let's try and look out at okay, let's go look at the overnight inventory. Okay, here's an example. Context. You're looking at the overnight inventory is almost 100% long. The market is fairly weak coming into the opening. There's the green line is the last trade overnight. The green dot is where we opened. And then we continue on down. But now I'll take a look at this context. We never got the overnight high out. The afternoon pullback low was at 23.51. And so that's the being reference. What happens relative to this? But this whole day was weak. It looked like short covering. Then it was joined by new momentum buying. Soft on the close, so you didn't close strong. And now overnight inventory is up because, you know, people, the easiest way people follow the prices up, because what they saw during the day was up. That's the way they tend to trade. Like I say, a lot of times overnight traders are weaker hands. The price momentum, I look at the structure and it was a terrible day. To price-based followers, this was a pretty strong day. So you got a different perspective. And weaker people tend to look at price-based. So it's up overnight. So now we come down, overnight inventory is long. We can't do much about this in the day, and the market starts down, pretty sluggish. But again, see how that context of taking in the previous day is, just so very important to me. Let's go back following the 19th. So the low on the 19th, the market opened way up here on the 20th. Overnight inventory is 100% long. Overnight inventory is 100% long overnight. So in this case, overnight inventory is long. The market opens and it sells off to exactly half back from overnight. But this is one of those days that I said can really be difficult. Remember I said if overnight inventory is long, a couple things can happen. One, you can get a full correction of overnight inventory. Comes down, takes the overnight inventory low out. Two, it can disregard it and trade higher. That's usually a pretty strong market. Or, I said the most difficult days to trade are those where the market initially trades with the direction of overnight inventory. So in this case, some liquidation. So the overnight inventory liquidation caused the market to hesitate. And mislead. You saw prices going down from the opening. You can hesitate, and all it was doing was getting a correction from overnight inventory. So the overnight inventory, the long overnight inventory, restricted or held back or constrained the early morning rally. But the trap was there that, you were well within balance. The reference I was using that night was the lowest as of this low distribution, and anything above that low distribution was very positive on there. So again, it all has to be considered within the context. And these are the kind of things, as we start to do the morning report, we do the report in the evening as we get started on Monday. But then in the morning, I do a morning report, which is an update to overnight inventory. And then we start talking about, the scenarios to that. And I try and lay out and give you some of those parameters. But let me take a section. I'm going to consider that question responded to. Let me take a section and talk to people that live in other time zones, and they do in fact trade overnight ES market. In the overnight ES market, there's usually three sections. You've got the section after we close until Asia close. You have when Europe opens, and many times those are entirely different markets. But if you are trading overnight, you really can't rely much on the profile, simply because of the fact there's not enough volume. You need enough volume, and another, which is data, to give you enough data or sample size in order to give you a legitimacy to the profile. You need enough data, enough sample size in order to really be confident there. You will notice if you trade overnight that it's not uncommon to have overnight highs and lows that are 2 and 3 wide. And it doesn't trade the same way overnight. Though some of the signals overnight, sometimes I'm very comfortable going against a poor high or a poor low, just because it's weaker traders and they tend to trade that way. Okay, other questions, comments?
Yes, it might be easy to have a daily bar to address this question, but the trading range highs and lows, she's referring to them as pivot high and low of the range. Does Jim think the March high will be taken out?
I have no idea. I mean, it's not, if anybody's, I don't focus on those things. Well, what I do is I take the market one chunk at a time. When you start focusing on the March high being taken out, you've just made this huge jump shift, and it's a cognitive thing to say, boy, it's probably a prejudice that you have, either up or down. But I have no idea if it's going to take out the March high or the March low or the April high or the April low. When you see the report, that's why I do the report this weekend. I use the on the profile chart itself. Profile chart itself shows the Friday high and low, weekly high and low, and monthly high and low. And then you take it a piece at a time. So, for example, we had an inside day on Friday. Friday settled about centered within Thursday's range. So I come in on tomorrow. First thing you're looking for is, okay, balanced trading range. Where do we build value relative to Friday, to the upside or to the downside? If we build it to the downside, now we've got a pretty good chance to, go down and test the lower side. But you take it a day at a time, and that's what there's such a difference between trading and investing. And as traders, and I keep coming back to tell the people, if you're an investor, this is not the place for you. We are traders, and to represent ourselves as anything other than that would be false. That doesn't mean that we don't start with the longest term information. That's why our homework is always from the top down. We look at monthly, weekly, daily profile. We're always trying to keep a perspective, what is really going on in the market in all time frames. Then we come down, and then we make our scenarios for the following day from a bottoms-up perspective. And the bottoms-up on Friday was inside day. Okay, let's see where we go relative to the balance. So the market's telling us on Friday it was a balanced market. Inside of Friday, it's a very balanced market. As a trader, that's all I'm dealing with. I had no desire to go home with any position whatsoever. It's a balanced market. Let me wait and see.
Okay. Let's talk about poor highs, lows versus weak highs, lows. And I'll pose this question to you. I get confused with poor highs and lows. I understand they are pretty weak and that more than one back-to-back poor high or low increases, the weak structure or the weakness. My expectation would then be that price can break these areas quite easily if they are weak. Or is this analysis completely wrong? So she's intermingling the poor and the poor structure. When you hear poor, you want to think structure, less than 2-tick excess. When you hear weak, that's referring to a market going exactly, say, an early morning trade, a tick above the overnight low, or something of that sort. It's not about structure. But go ahead, Jim.
A weak means it went and rallied or broke from a mechanical, easily identified, visible mechanical level. I use them most often when I use them particularly when I'm looking at daily highs and lows. But you get a market that goes back during the day, it breaks to exactly half back. Okay, in that case, that's a weak low. It went to an exact reference. And the question is, who buys at an exact reference? More than likely, that's not your strongest hands trader. It's more than likely either somebody has to cover a short or it's weaker hands momentum trading. Now, so we have weak references that take place throughout the trading day. And they're weak because they went to an exact visual level. Then we can also get a weak high or low on the daily profile, simply because it went to within a tick of the previous the previous day's reference. Here's a example right here. Okay. On the 19th, we had a good high because there's 2 ticks. Not a wonderful high, but it's 2 ticks. But it's weak because it went 1 tick below a previous very visual high. So now you have a good high, but a weak high. So I use this idea of weak references relative to intraday trading. You know, it went to exactly half back and rallied. It went to the early morning low and rallied, something of that nature. But I also use it when I'm looking at the day time frames. Okay, and I understand that concept is a little difficult. It is. I made that observation, and I don't know, what is it, Julia? Maybe 3 years ago, and
maybe 2, maybe coming up on 3.
Okay. It is the single. When I made that observation of weak highs and lows, it is the single biggest advancement in my short-term trading that has occurred over my entire trading history. And it just opened my mind. It really allowed me to have such a much better understanding of what was the behavior of the people that I am competing against. And to me, that is just exceptionally important. I know that the majority of people are not successful. So I don't want to be with those people all the time. Now, there are certain times I want to be with them. For example, if you think in terms of, one of the times if somebody tells me I'm a contrarian and they're very proud of it, I know that the odds are very good that that person is not going to be successful as a trader. Because here's what happens. At highs and lows, so you make a high on, one high, and it's a good high, you may want to be a contrarian and fade it. You leave a combination of, say, a poor high and a weak high. Now I'm not nearly as interested in being a contrarian because the chances are that it's not over. So this whole idea going through my mind is, when do I want to be a contrarian? When do I want to be with the masses? Because if you think in its simplest form, where is the most money made in the market? You have the early adopter. You have the innovator, early adopter. Then you have the early majority and the late majority. The real money for most of the people is made in the early and late majority. Then when you get to the laggard on the other end, then that's where you want to be a contrarian again. So, you don't want to be that all the way. But what has helped me is this idea, particularly weak daily highs and lows, helps me understand the odds. So even if I make a weak high and the market breaks, then there's a pretty good chance I'm coming back, just as we had 2 last week that were back to back. And that's the kind of thinking I'm constantly going through. But then the weak references throughout the day are very helpful for very short-term trading also. Example, going exactly the half back, going exactly to the opening. Let me show you something from Friday. It's amazing when we talk about this stuff, how many time we had H period at one time was 3 ticks, so you had F, G, H low. So I have this is an okay low. There's still 2 ticks. This becomes weaker because, this is so close to that. And then I get H right here. So I'm looking at this. And remember, this is before H broke below G. But I'm looking at this and I'm saying, okay, what is going on here? What is going on here is momentum traders from the previous day are buying. Look where they're buying. The double distribution from the previous day would have been closed at 23.4475. D period low is at 23.4525, a single tick above it. So this is a good low because it's got single prints. It's a weak low because it is a single tick above closing this distribution, or another thing, a very visual point. So I'm watching this the whole time, and incidentally, I'm holding a short position through all of this. F period comes down, and we still have 2 ticks, and I'm still not sure about my position. G period comes down, and then when H period came down, I have the FGH. Then I'm pretty comfortable. I'm okay. So this information, D period was a weak low. Then the FGH being just, perfect little trend line, said, okay, now they're in trouble. You're going to get the liquidation. Then you got the liquidation. So that idea of the weak reference was very important, and it got weaker. However, there's another concept in here. The fact that we had so much trouble taking out or getting into this lower distribution in these periods and the buying, if I had any real selling, anything other than liquidation, if I had anything other than liquidation, it's not going to stop at these exact levels. This, when I see it go to this exact level, that's very weak hands mechanical traders. So now I've made multiple decisions. I don't think this is any good. I think it's weak, but I also don't think there's any real selling. So as soon as this market breaks in H period, and I let it run just a little bit, it's breaking right down here, I am in there in the market, and I am going market. I'm selling my puts, and I'm selling them all at the market. Now, normally you don't see me put in market orders. But when this broke down here, I said, I think because this was so questionable to begin with, I think all I'm seeing is liquidation from the previous day. I think the odds are small that we get carried through. I don't know that at the time, but it goes down here. I'm then using that. I'm just going market to get out of my puts. I close for the day and I leave for the day. So again, that's how I use this information. Now I understand there's a lot of experience in that. There's some complex thinking in there, and it was hard. I must admit it several times. I wonder if I'm right, because we come down in D period, and we rally all the way back up to E. F comes down, we rally all the way back up here. And you keep wondering, am I right? And there's always questions, but I stayed with it because I thought this was a weak low, and I thought every time it rallied, all I was doing was adding more long inventory to inventory I thought was still overly long from the previous day. Okay, I'm sorry, that's a long explanation, but there's so much involved in that question, and the use I make of these weak highs and lows, weak references, and strong highs and lows, and there's so much involved in how I use that to assess the odds of trades in the marketplace. I hope I didn't confuse everyone.
No, I don't believe so. That sounds good. Do you consider concepts like accumulation/distribution? In other words, is there a way looking at the profiles to say if strong hands are silently accumulating/buying or distributing/selling during trading ranges?
No, I don't pay any attention to those terms. I'm certainly well aware of them, and I've probably used them at some point in time. But it's not part of my thinking. Because remember, I am a shorter term trader. When you're starting to talk about things like accumulation and distribution, you're talking about swing. That's more applicable to swing traders. Now, that doesn't mean I don't do swing trading, but my concept of taking the market, one step at a time, kind of belays that. Now, but I do, without using the words, I do see those things occur. For example, if every time a market trades off, volume dries up, and when the market rallies, volume increases, now I've got a pretty good idea that's a market that's under accumulation by longer or more serious money. I mean, I don't use those words, but I intuitively know. What I do is I look at it and say, what do the down days look like compared to the up days? And if I find that the down days are consistently weaker than the up days, that's pretty seriously information for me. But I don't think in those terms because those are not productive terms for me. Being a short-term trader, I have to think much more closely to what is going on in day and overnight inventory. Now, again, that doesn't mean that I won't find something that's, hey, 3, 4, 5 days in a row. And, but what do I want? If I'm going up, for example, I want to see value go higher every day, right? I want to see value go higher. Let's go back and see if we can find some time like that. Like I said, the market's been in the trading range for so long, in here. But here, okay, take a look right here. The market comes out of, did we lose me for some reason? Can you hear me all right, Julia?
You're good.
Oh, okay. My ears were funny. Okay, well, come out of here. The two most important concepts we ever deal with are excess and balance. The reason for that is when a market puts in excess, that's the end. Here's excess right here. That's the end of one auction and the beginning of another auction. And we got excess on the low. When a market comes out of balance, our balance trading rules are go with the balance, fade any balance that fails. So in this case, the market comes out of balance to the upside, okay? And what is that? That's an indication of a new auction getting underway. Now, in this case, it's a pretty strong option, a market getting underway. Because you see, we come out of balance, market trades higher, value is higher for several days in a row. Now, there's some structural things in here that make me question the longevity of it, but you don't fight this. Value's higher, value's higher, value's higher, value's overlapping to higher, value's overlapping to higher, value's overlapping to higher. Barely on a down day, we get just a little bit of overlapping to lower value. That's all it could bring in. And, so again, in this case, market's going higher. I'm getting some longer term funds coming into this market. So again, when I lose this, I'm not going to fight this. Some of the biggest losses I've ever had is all of a sudden I'll look at a day like this and I'll say, wow, this day doesn't look very healthy to me. It looks like the big letter P formation. I don't think this is not very high, not very good. And, I said, boy, I'm going to fade this market. Well, when you come out of something this strong, you got higher value, be very careful, even though the next pour low the next day. And I don't know, some of these profiles are older, but, you don't fight the value. You don't fight value in there. For any longer term, you may do little short-term trades against it. But, now you got a different situation. Now, where do we come? Now, somebody said earlier, how do I know we're in a trading range? All I have to do is look. And, we're moving sideways. So we're getting markets to go up, markets to go down. So now I have to adjust my trade to so much of my trade right now recently, it's inventory getting too long, inventory getting too short. And this is what short-term trading is about. But again, why I start with the monthly, weekly, and daily is that I want to have this broader perspective so I don't lock myself into some cognitive opinion that the market's really weak or the market's really strong, because those are killers. Those are killers. You get locked into those, you can't let go of them, and then all of a sudden you're out of the business. A couple more questions.
Yes. I don't know, Jim. Yes, sir. I'll get to. We can see about crude, but let's get this question concerning strong money. Do I understand that when I am looking on a market profile, its structure on the 30-minute construction, I can't recognize strong money even if they are in there trading?
Yeah, it's a combination. I mean, strong money isn't something that's a switch that turns on and off. It's a is there a net addition or subtraction by the stronger money over a period of time? So you're looking at the construction of the profile as one thing, but you're also looking at value. You're also looking at volume. But one particular day isn't going to do a lot to you. It's just not going to do a lot for you, because there's always other things going on. But when you go back here, where we were looking, where was that? When I see this coming in right here, and take a genius that I know there's stronger money coming in this market. We're going higher. 1, 2, 3, 4, 5, 6. Value is higher in some shape or form for 6 days in a row. When I see that happen, I've got an indication of some pretty strong support underneath that market. Or there's no selling. You gotta always. This is another way of thinking. You always gotta. Markets go down a lot of times, not because longer term money is selling. They go down a lot of times because longer term money is not buying anymore. And longer term money cannot be buying anymore for a couple of reasons. One, investors, pension funds are not adding money. Individuals are not adding money. So the funds aren't getting new money to put into the market. Or another reason is they become hesitant on the market, so they start to build a little bit of cash position. Now, normally these large money managers, they're normally about 97.5% invested all the time. But sometimes you'll find out that they're only 95% invested. So what have they been doing? They've been buying, they've been building some cash. So it's not as simple as it might appear, but when you see value going higher every day and you look at the monthly one time frame and higher, you got a pretty good idea that you got some pretty steady underpinnings to the market. You had if there's any more on that question, but then.
Well, let me make a comment. Can I, sorry to interrupt you, but one of our clients here is making a comment. As an ex-market maker, regarding strong money, a good trader will be in the market and retail should never know. Our job is not to show our big hand in the market, especially when we have a big order.
It's a great comment. And as I've told a lot of people, I ran an institutional desk. And one of the comments you hear me make a lot of times, you'll see a day where the market is just unbelievably stretched out, multiple distributions. And I'll say in that case that, that was probably short covering or some rumor, something, because institutional money they don't butcher a market. If I'm running an institutional desk and I've got a large order to buy, for example, that may take place over several days. I may take place over several days. So, I may buy, I let the market settle, I can buy again, let the market settle and buy again. And I'm not trying to advertise. I'm not trying to advertise to the world what's coming in. One of the reasons that so many of these off exchange and, these pools and everything developed was to hide, who was in the market, who was doing what and when. So there is a tremendous desire of these people to, disguise what they're doing. However, when you have, if you have one large institution that's buying or selling, they can disguise that. You got multiple institutions that are buying or selling. that gets much harder to disguise. You see it in the overall market. This is why the profile itself, the value area itself, is a great filter to me to what is really going on underneath the market. But one of the things that I want to tie into, I want to thank you for that comment. But one of the things that I want to tie into this is this idea, just because price is going higher doesn't always mean that it's strong money. I mean, I just showed an example where, if I'm getting underlying support, if I'm getting a higher value every day. But there's other clues, because sometimes there are markets that go to ridiculous levels just because speculators are taking them there. So if speculators are taking markets higher, for example, it may be that nobody's selling into them and they can get away with it. But I want to show you, when somebody's going to ask about oil, I want to show you something. You're going to see this again. You're going to see this again on the weekend report, because I'm equating it to something that I see going on in the daily bar with the E-mini right now. But let me go to crude oil here for a second. And anybody that has been with us for any period of time has heard this multiple times. Here's an example of some of the hardest markets to understand and where you can get into a lot of trouble by following price. When I see crude oil, and I have a friend out in California that I've been talking to about this for some time, and what I'm pointing out right here, you have a low. See how close this low is to this low, to this low, to this low. This almost perfectly fits a trend line. When I see that happening, that is very often an indication to me that I have momentum spec buying taking place in this market. Here's another example right here. Look at the trend line along here. Almost a perfect fit the trend line. Look at the break. It took all this back in one day. When I'm looking here, and I was telling my friend, I said, this market looks very treacherous to me. The problem is you don't know when. So this happens for 1, 2, 3, 4, 5, 6. Then we gap higher, kind of exhaustion gap. Then we move higher for 1, 2, 3, 4, 5, 6 days. But I'm watching this the whole time. I'm calling his attention to it the whole time. And you say, you don't fight this, but it just looks like it's active. It looks like it's getting very long, and it looks like it's spec momentum long. And we see this so many times. When I see this formation very often, it takes it back very quickly. So we look, and what happened in 3 days, we took back all of the high. We took back all of these lows and filled the gap. So we took out 1, 2, 3, 4, 5, 6, 7. We took all of these back in short time. That is the kind of thing that we see happen. So again, getting underneath the surface in this deeper understanding of what's going on, sometimes I can read it off of a bar chart. Now let's go back. Well, you're going to see this on the weekend report, because I want to go back now for a second to the ES and show you what I put on the weekly report. Okay, notice 1, 2, 3. See how close these are together? A little higher, 4 and 5 here. I'm watching these, and I don't think this is a very secure formation. Is it still going higher? Yes, it's going higher. But one of these days, if we break hard, for example, now Friday was an inside day. So let's say Friday comes in out of the inside day, breaks to the downside, take out Thursday, And now these are in range, and these could be taken out pretty quickly. But again, here's the problem with showing you something like this. Let me go back to the crude oil for a second. You know, you could see this, and if you saw it, oh, Jim showed me this formation. Well, you know, you get short, you get wiped out, and you say, boy, I don't know why I ever listened to him. But what I'm saying is caution, that when I'm talking about information you carry forward, and I'm saying I think this market is getting long. I think it's getting long with weaker hands momentum traders. But they are, and I respect momentum trading. We're doing more with momentum trading than we ever did. I'm saying don't fight it. Don't fight it. It's the most followed strategy in the market. It is, and it's the most followed because it's the easiest. So that means it's the easiest. It means it's going to get the herd instinct there. And the herd instinct, you know, you don't want to be in the front of that herd early on. But later on, when that herd starts to, you know, to lose its steam, you certainly want to be around when they reverse. But, you know, it takes patience to see it coming. So I'm watching this, and I'm cautioning about it probably from here on. And then you go 1, 2, 3, 4, 5, 6 or 7 days before it materializes. When it materializes, it's a tremendous trade. Now we go back to the ES. Okay. Do I see this as a potential developing? I'm sorry. Hold on. See if I can elongate this a little bit without messing it up. Do I see this as a potential? Yes, but you have to have the patience. You have to have the patience for it. And so now, you know, an inside day, and I'm saying, okay, what if this week, what if we come out of this inside day and, you know, to the downside and take out Thursday? Now this becomes very vulnerable down here to cut back through this, and getting back down to the to this gap down here and everything becomes very vulnerable. But you don't want to lean into the wind till this happens, because it could be a long time. But once, if all of a sudden you start to happen, then you start to be able to look forward and say what may be the potential in this trade. Okay, here's one on the upside. Here's one that went to the upside. Just notice as this market's coming down. This market's coming down, and these are almost perfectly fitting a curve along the line. Momentum selling. Well, look what happens. In just a couple of days, in 2 days, we take out all of these lows. That's the kind of stuff that happens. But a lot of times, there's a delay on it. And you have to understand how this trade is setting up. Okay, we're getting really close to the 2 hours. I am getting very dry. A couple more questions.
Okay. How about market internals to help monitor, and this is from the ex-market maker, you know, professional trader, to help monitor for continuation, breadth, you know, advance, decline, volume, you know, things Peter speaks about at Shadow Trader. Could you make a comment to him just to add some flavor of your perspective?
I do not use them.
You see them on CNBC.
Yeah, does that mean
Yeah.
It doesn't mean I'm unaware of them, but it's not something that I pay much attention to. I pay far more attention to value. I pay far more attention to the weak references we were talking about and how the market's trading relative to the references than I do the internals. Just as, you know, you'll have days where the NASDAQ is totally different than the E-mini, and people say, oh, you know, look at the NASDAQ. I said, well, you look at the NASDAQ. You know, am I aware of it? Yes. But I just, one of the things we can do as traders, we have a tendency to go out and collect all the information we can collect. And there's this intuitive feeling that more information is better. There is a substantial amount of research that you see over and over again that more information is not necessarily better. More information may cloud your judgment, and it may bring you to inaction. So many times I've seen, well, you know, as I said one time that you know, I was involved in the institutional side of the business. I was involved in some program trading, And I know that you can, you can make the market, you can make particularly big ticket, particularly little ticket and breadth, you can make it look very inviting for short periods of time and sucker in a lot of people. Yeah, I know they're supposed to put rules in place now to control that, but I'm not convinced. So I just, and everybody looks at, look how easy it is to look at advanced decline and breadth figures and all of that. It's exceptionally easy. So how many people do you think are looking at? How many people do you think kind of use that as the Bible? An awful lot. How many people do you think understand what a poor high or a poor low is? How many people do you think understand, looking at how a market trades relative to the opening, relative to half back? Very few people can have that information. That's information that we use. So we're using something that's not nearly as widely followed. And I think the more widely followed something is, the less important it's going to be, in my opinion. So, and we can also, like I say, there's a tendency to pick up more and more pieces of information. More and more pieces of information very often, I think, can lead to confusion in decision. Anyhow, it's a personal decision. But if I said I don't look at all, I'm aware. I'm aware if the market's 8-1, on the downside of the sell side, not real high odds that we're going to reverse that day. Okay, let's take another question, and then I'm getting worn
Okay,
out.
I have two that I'd like to get to, and then we'll leave it alone.
Okay.
If I trade options, how does Jim balance trading options when the market goes against him, but there may be 2 or 3 days left in the option?
Number one, I use the shortest options available. I use options simply as a trading vehicle, so I'm not staying around very long. So I'm not, the shorter the option, the better for me, because it's actually less price. It may have more time decay risk, percentage-wise, but the actual dollar risk is important to me. But I'm using it as a trading vehicle. And I always start with the point of view, if I think the market's overvalued, more than likely the put is undervalued, type of thing. Let's go back and see if I can give a couple examples. How I would use them. For example, okay, and I think I may have used this in a webinar the other day, but when I came back from Hawaii, I looked at this market, never stopped one time framing, one time throughout the day. I bought puts that night. I think I bought puts that night. And I get out the next day, and all I'm saying is the market's overvalued. I think there's a put. I buy them for a trading vehicle. They reward me, and I'm out of them. So again, I don't worry a lot about the the decay, because I'm not in them that long. This time I'm very seldom do I take them home overnight. If I take an option home overnight, it's because, let's say I own puts. If I take an option home overnight, it's because I went long futures someplace against those puts. So in other words, the market, I bought the puts, the market did what I thought it was going to be. The break on the downside wasn't as aggressive as I thought it could be. And I think, well, there's a pretty good chance this market will bounce. And at that point in time, I might be long puts, long futures. So my futures are heads against the long puts. In that case, I may hold the put a little bit longer. But when that happens, usually any profit is more profit realized from the long futures than from the puts. So I'm not looking at the Greeks and trying to evaluate what my time risk is. Okay, last question.
If price is coming down and stops at a monthly price reference, a high or a close, for example, is that any less weak because it's a higher time frame reference?
No, You got two things to be aware of. How, when it went down to that reference, did it go down on good structure and good volume and bounce off of that? Okay. If it went down on good volume, good structure, I say, well, yeah, it held there temporarily because it's a very visible reference. Now I may want to sell the next bounce. But if it went down there and it went down there on low volume and poor structure, now I will give that reference, may be a more lasting reference because of what the volume and structure look like on the trip to that reference. So again, I'm always bringing in context. How did the trip go getting there? You know, was it a scenic trip? Was it rainy? Was it stormy? But I still will record it anytime it goes to an exact level. The buying from there was more than likely weaker hands buying. That doesn't mean it can't go substantially higher, because it may be momentum traders. That may be all that's in the market. The other time frames may not give a damn. So I respect it, but I'm aware of its quality. But again, everything has to be considered with some type of contextual outlook, and that's why I don't like, for confidence, I don't like price-based systems. Over the long run, I understand they may give me opportunities. If I understand what they're doing, they may give me an opportunity, but they're based on one thing, price. They're not based on any underlying context. Anyhow, let me say thank you very much. We start the Monday with giving 2 reports each day. I will be on the chat. It won't be quite as aggressive as it will be starting the following Monday. But remember, this whole idea of the kickstarts, and this whole idea of starting the reports a week early, starting the chat, it's to give people the best opportunity they can to be able to get the most out of the Mastery Series when it does get underway. Give everybody a chance, because this is it's not easy information. It's not easy information. It takes time to observe the terms and what we're talking about in the context. But once again, thank you very, very much.
All right, great. Thank you, Jim. Thank you, everyone, for hanging in here and asking great questions to help each other. The Kickstart report will be coming to you. In that report, we'll tell you that there's a Kickstart webinar at noon on Wednesday, April 26th. Okay? You can see that information in the email, and we'll post that at the training site. Also, we have a webinar on Wednesday, April 26th at 4:30 p.m., which is different references for different time frame traders. That is a public webinar that you can register for at jdaltontrading.com. Okay, and also it hasn't been announced yet, but since you're here, Peter is going to host Jim on a webinar on Thursday, April 27th, the noon hour Eastern time. So you can check with Peter, and we'll probably put a post on our site as well. So there's some things upcoming, so stay plugged in, and the Kickstart report email will be coming, let's see, tomorrow, okay? And the daily report email for the Mastery Series will come tomorrow as well. There'll probably be separate distributions. They will be. So you may get a double there, and I apologize in advance for that, but it'll only be this week, and then we will stop the Kickstart reports and pick up with the Mastery in full. So thank you very much, everyone, for being here. Please contact us through email or phone, and we'll be happy to answer any questions for you about the upcoming program. And we hope you have a wonderful rest of your weekend. Okay, and thanks again for coming out, and we will see you next Wednesday, April 26th. Okay, take care. Bye-bye.